JJ the CPA here. Hope you're doing well. Let's talk about the employee retention tax credit and the aggregation rules. What? Yeah, this is getting into minutia, but this is a bigger deal than I think most of us are realizing. And I might have included myself in that category up until very recently. But when we're talking about the aggregation rules, when we're talking about the ERTC, the Employee Retention Tax Credit, what is that? Well, it's basically going, hey, we got some entities out there with some common ownership. And so do they get aggregated together in determining if the employer, the business, the aggregated group of businesses qualifies for the employee retention tax credit? Now, I will have to say, I think that the IRS went out of its way to show a number of things related to aggregation to make it easier to prove aggregation, because ultimately an FAQ that is now obsolete needs to be made obsolete. It is up on the IRS website. But the FAQ number 80, which is now obsolete, even though it's still up, indicates that with an aggregated group, if any business in an aggregated group got PPP, they were then not eligible for the Employee Retention Tax Credit. Now, we know with the Appropriations Consolidation Act that was signed into law on the 27th of December in 2020, it did away with the provision that if you got PPP, you weren't able to get ERTC. Let me state it another way. You now can, by law, retroactive back to March 13th of 2020, take advantage of the Employee Retention Tax Credit if you qualify and get PPP. So getting PPP no longer affects your ability to take the Employee Retention Tax Credit. And don't get me wrong, the IRS can't come up with its own rules, and the IRS can't just find a way to come up with a way to exclude a bunch of people. But in the original CARES Act, the IRS had to be mindful and careful to ensure that it was describing and was following the law as it relates to ensuring that an aggregated group didn't have one of the businesses in the group get PPP and another business in that aggregated group get ERTC. So we do have a number of examples that we're going to look through on the FAQs. But what's really the conclusion here? Okay. Well, the conclusion is that it's pretty easy to aggregate, because what the IRS pulls together from the CARES Act, and I'm going to walk through it with you, but it pulls into section 52A and B and also 414 M and O. What does that mean? Well, these are descriptions of controlled groups, affiliated groups, and both of these are wide open for showing that there is a aggregated group. And again, what the conclusion really could be out of this is that you could have businesses that maybe aren't related to each other, as in it's a law firm and a bar, but it's owned by the same individual. You might be able to find a conclusion here that the restaurant and the bar could affect each other as it relates to the Employee Retention Tax Credit. So it may be that you have a law practice that, for whatever reason, doesn't qualify for the ERTC, but that same owner owns a bar, and that bar does qualify for the Employee Retention Tax Credit. And so you could come to a conclusion that, well, that owner that owns the bar and the law firm, well, because the bar was affected, that then the law firm can take advantage of the Employee Retention Tax Credit. At first glance, you go, well, that doesn't seem right. That's not fair. That's not how that should be, right? Well, that's what I thought too. But one of the things to note here, okay, is that we're like barely over 30 days of the new Consolidation Appropriations Act, okay? Yes, the CARES Act came into play last March, but many of us, most of us, didn't have to get much into the Employee Retention Tax Credit because if your client or if you got PPP, you were blown out of the water. You weren't able to get ERTC. Well, every single one of my clients got PPP if they were a business and had wages. So I didn't have any clients that were able to get the employee retention tax credit. So it's not been until March 27th, scratch that, December 27th, that it's been now back on the table. So when we're looking at this and we're looking at the aggregation rules, all I'm saying is you might be able to conclude, but you're definitely going to have to draw your own conclusion on this if you own a restaurant and you own a law practice, or a bar and a law practice, if you will, meaning you own two different businesses, and whether it's 100% or whether you have a controlled group, this is a complicated matter. But if you have two businesses and they're unrelated to each other, law practice, restaurant, right? A yoga, Pilates studio, and an architect, right? Well, if both of these businesses are aggregated together for ERTC purposes, then if the yoga studio is affected, then boom, the other business gets to take advantage of the ERTC. A couple of things to note before we get into the minutia, which some of you may then push on and not want to go through and hear all the minutia, and as I walk it through with you, which is okay, is that it is made clear, especially by the IRS through the FAQs, that the aggregation applies to everything. It applies to the employer size, it applies to gross receipts, and it applies to the governmental shutdown aspects. So when you look at then the credit and the wages and all the other aspects, aggregation doesn't just apply to one of those things. Aggregation applies to everything as we're talking about this. That then leads you down a rabbit hole of going, well, wow, if it applies to everything, then maybe common ownership, controlled groups, affiliated groups, right? Aggregated groups would all qualify, which could be amazing, because you could have somebody that owns a business on the north part of the state that had no effect, and you could have that same owner that owns business on the south part of the state, and they have nothing to do with each other than they're just owned by the same person or controlled by the same group of individuals. And if the one on the south is affected, then the one on the north will be able to take advantage of it. It doesn't seem logical, but I have said many times, when we're doing our research, we can't insert our own thinking, our own language. We can rely on our experience. We can rely on what we feel we're reading and how it all fits together. We can reasonably put things together. So with that being said, I am going to tell you this. I am not going to draw a conclusion. So you can go ahead and stop watching from here if you'd like, because I'm not going to draw a conclusion for you. And here's why. I don't even know how to say a number big enough for you how many different scenarios somebody could come up with that would seem outlandish, but then could cause the entire aggregated group to qualify. There's no way I'm going to be able to come up with that many examples, or I'm not going to even try and come up with an example that would then no way apply to whatever your circumstances are. So if you have an aggregated group, if you are working with a client that you have an aggregated group, then I'm going to, in the rest of this video, show you where we go, show you what can be looked at. I'm not going to deep dive as much as I might in other videos, because literally it would be 2 to 3 hours on this one subject. And I will tell you this, I don't have any clients myself that this is going to apply to. So I did want to mention, if you got to hear, that I did a seminar. It was 2.5 hours long on the ERTC, and I did 3 hours of Q&A. You now can, in the link below, get access to that seminar by video, and then you would be able to get all of the materials that went along with this. So let me go ahead and share my screen with you and what we're going to walk through. I do want to just show you right quick, if you don't mind, For those of you that might be interested in going through the ERTC seminar and getting the video for that, I've got a PowerPoint that is well over 100 pages long that you would be able to get access to follow along. How many pages is it? Yeah, so 151 pages. And then you'll be able to see the video. There's a private research video, and then you get access to all this, which is examples, Excel spreadsheets, options, flow charts, all of this stuff. And then I added some new sections about the reporting of this for federal income taxes, and then related individuals, as well as then the aggregation. So what we know is, back to the aggregation, is that in the law, right, in 2301D, aggregation rule, all persons treated as a single employer under sections A and B of section 52 of the Internal Revenue Code, or subsection M or O of section 414 of the code, shall be treated as one employer for purposes of this section, as in 2301. So this is out of my slides, and then also I give you access. So for those of you that are watching this that were at the seminar, you have access to this. This is just the plain language that I've got up here, where I just copied the law and I just put it directly into Word, which just makes it easier to read. But nonetheless, we talk about the aggregation. So in here, I just made notes that section 52A on the aggregation is about controlled groups based on more than 50% ownership, including parent, subsidiary, brother, sister, or combined controlled groups. 52B is about, it applies similar aggregation rules to partnerships, trusts, estates, and sole proprietorships. And then we've got section 414M or O, normally is used to determine retirement plans and other employee benefits applied to affiliated groups. So we did have somebody during the seminar, during the Q&A, that presented a question that hopefully they're watching this video, because I thought of them specifically, where they have, if I remember it correctly, the spouse owns 100% of an S Corp. The other spouse owns 100% of a Schedule C, sole proprietorship, and then they each own 50-50 of a partnership. And combined, all three of those entities, they meet the gross receipts test. If not consolidating, I think it was only one or two of the entities met the consolidation or the gross receipts test. So pretty big deal for that individual in trying to solve this. So hope this video will help, even though I'm not going to per se draw a conclusion, although it does seem as though, contrary to what I had indicated last night, that last night in the FAQ, I had said, well, the aggregation was related to determining the number of employees, but the aggregation wouldn't come into play related to gross receipts. Well, when I looked further, the aggregation does also apply to the gross receipts test, and the aggregation also applies to whether or not there was a partial or a full shutdown. Now, what it does indicate is that you will, though, report any ERTC, employee retention tax credit, in that individual business. So the S Corp, even though aggregated in this example with a partnership and a sole proprietorship, the S Corp would report its own ERTC, the partnership its own ERTC, and the sole proprietor's ERTC. Now, there's another video I did on the related parties. It does specifically state, the IRS specifically states that self-employed are not included, as in the self-employment earnings. And I would include that also with the partners, even if they have self-employment earnings. I believe that the ERTC is only related to wages, and you'll want to check out this other video. I've got a link to a playlist of videos I've done related to credits. So you'll see a video I did related to individuals. Why am I going on about individuals? Well, individuals pull together and create controlled groups. You have individuals together, related, family attribution rules, right? Husband and a wife, boom, together, easily make a controlled group, easily pull together and create an affiliated, an aggregated group opportunity. So again, back at the beginning, I said, I think the IRS, in essence, might have outsmarted itself. And of course, I'm having a little fun because when we look at question 80, which is absolutely obsolete, but in the FAQs of the IRS, number 80 is indicating that you can't get PPP and ERTC. And what they indicate here is that if you have an employer and they're part of an aggregated group, and one of the businesses in that aggregated group got PPP, then no businesses in that aggregated group can get ERTC. We know that that's not the law anymore. That got erased. That's why this is obsolete, number 80. Because it says right there, if multiple entities are treated as a single employer under the aggregation rules and only one of the entities has received PPP, does this mean that all the other entities in the aggregated group are not eligible for the ERTC? And it says, yes, an employer, boom, boom, boom. Now, I am going to walk you through a few things. I do want you to note, if you're not familiar with this, but the IRS does indicate that anything on its website, if you will, that's not from an internal revenue bulletin, not in a revenue procedure, not in a revenue ruling, if you will, we can't rely on. Okay, right there, FAQ not included and may not be relied upon as legal authority. This means that the information cannot be used to support a legal argument in a court case. Now, don't get me wrong, the IRS is not going to intentionally put anything up to try and fool us or throw us off the scent, so to speak. And nonetheless, number 80 is obsolete. It doesn't follow the law. But now that we're going to look at a few other things, it's just worth noting there. So when we look at the aggregation rule, this is all that we get in 2301, and it's section D is aggregation rules. Well, they apply. So when we're talking about those code sections, I've got a link for you, or you can just Google 52A and B, Internal Revenue Code. But for those that took the seminar are going to buy the immediate access to the video and the seminar and the PDF and all the links, I've got a link for you in the section about aggregation. But it talks about an A and B controlled group of corporations, and then it talks about employees of a partnership, proprietorship, etc., which are under common control. So you would need to look at this A and B, and then it references the other code sections as this relates, or what code sections don't apply. So when you're dissecting, this is where you would go related to control groups, and then for the employees of the partnership, proprietorships, etc. And then what's also referenced in the law is section 414M and O. So this talks about employees of an affiliated service group in M. And you can see there's a lot of information in there. Now, again, this is really then meant for, in essence, retirement plan determinations. And then also 414O are the regulations that fall into that. And so again, my point in referencing this is that, like we see in other parts of the law, is that these two sections don't have anything directly to do with the CARES Act, but these two sections are referenced in the CARES Act by indicating that these rules need to be filed. Now, when they say these rules, it's just 52A, just 52B, just 414M and O, but of course, in any of those specific items, if there's another code section referenced, you would need to go to that code section. Now in the FAQs, it's number 25 and number 26 and number 37 and 50. So I've got these marked. You've got links to them on that web page directly, or you can just go to irs.gov, employee retention credit, go to the FAQs and go to 25, 26, 37, and 50, because we know 80 is obsolete. But it says which related employees are aggregated and treated as a single employer for the purposes of so the employee retention. And again, it references there for us in 25 those code sections that we need to take a look at that. So generally apply to determine, ba-bump, 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 and then it's going to give you a summation of 52 and 52B and 414M and O. So even though we've got them here, the IRS is going to break that down to you, and it's indicating that when you have a parent, subsidiary, a brother, sister, a chain of corporations, the controlled group aspect, and then the aggregation applying to the partnerships, as well as trust and sole proprietorships, and then you have the affiliated groups. So in essence, this is giving you a breakdown of those code sections that you would then need to take whatever your circumstances are, and as you're reading that, pull out of here, okay, what applies to your set of circumstances. So as you can see, basically, it's saying that the related employees that are aggregated together are those that meet this definition under these rules. And then we have number 26. What is the impact of the aggregation rules that treat related entities as a single employer? Well, all entities of that group of a control group of corporations or group of entities under common control under those code sections, okay, are considered a single employer for purposes of the application. As a result, these employers must aggregate for the purposes of the following. Okay, well, we know that what's going to have to be taken into account is every aspect of the ERTC. And at this point, it may just be working to the advantage for many, okay? But it's talking about in determining if the business had suspended operations, you're talking about the gross receipts, as you're talking about how many employees there are, and then also as it references here, rules that would preclude an employer from claiming it. Now, here's the thing. You might have a consolidated group here, an aggregated group, and as a group, they don't meet the definition anymore. Or as a group, they now have over the employee limit. We know that there's 100 or less employees that have certain rules in 2020, and then 500 and less employees that have certain rules in 2021. Both those rules are the same for both those groups, just depending on the year. But you have to take a look at all of that in determination. So it may help, but it also could prevent. Now, also when we look at 37, FAQ number 37, which you have a link on the page, or you can just go and find it. If the operation of a trade or business of one member of an aggregated group are suspended by a governmental order, are the operations of the trade or business in other members of the aggregated group considered to be fully or partially suspended for purposes of the ERC? And it says yes. Then it gives you an example. All right, so basically right there, you have an indicator here. Now in their example, they have a restaurant chain and it operates as a single trade or business. So that kind of falls into my logic that, okay, well, yeah, they're all the same kind of business, but what's clear here is that it's not about being the same kind of business. And what I'll tell you is that when I was looking at the aggregated group originally, incorrectly, in essence, I was thinking through the aggregated rules related to the qualified business income deduction. Well, part of that's because that comes out of the code sections that we've been talking about. But when I was reading about controlled group previously and aggregating, if you will, I was going to, in essence, what code section 414 is, which when you look at code section 414M or O, which is typically what I'm dealing with in the tax world, basically we're dealing with groups that are affiliated, they work together, they're connected, they service each other, those kind of things. But what is clear is the word or, because 52A and B or 414M and O can be applied. And so anyways, this stuff is just, quite complicated. obviously. But my point is that when I was going through this originally, I understand it said 52A and B, but I was really drawing a conclusion based on my experience that we would need to have, some common interaction amongst the businesses, if you will, related to the controlled group. But this is now also talking about affiliated groups to be pulled to aggregation. So why am I telling you all this? The net is wider than I originally thought. Now let's keep in mind here, okay? This new law we're dealing with that makes it retroactive at this point is, I don't know, probably 36 days old. So we're early into this and unpacking all of this. My clients all got PPP, so I didn't have any clients getting the ERTC. So I'm glad to be unraveling this for us. All right, so we talked about 37, right? And then on number 50, does an eligible group identify the average number of employees based on the aggregation rule? Yes. So you aggregate all the businesses together and how many full-time employees were there? Because based on the number of full-time employees in 2019, it then determines the rules you follow in 2020 and in 2021. Yes, the full-time employees in 19 is what determines how many employees you use in determining the rules in 2020 and in 2021. Okay, so it's truly full-time employees. They have a section that talks about that. That's employees that work at least 30 hours a week or 130 hours in a month. And then you're taking the number of full-time employees each month and dividing it by the number of months that you were in business in 19. So if you're in business all of 19, then you're going to take what the full-time employees were, not full-time equivalents. You can take what the full-time employees are in January, February, all 12 months, boom, divided by 12. That's how you determine it. But in an aggregated group situation, you're adding all of the employees together, all the full-time employees together in 19 to come up with what is then the rules that have to be followed, because we know that if the number of employees in 2020 is 100 or below, or if the number of employees, full-time employees in 2021 is 500 and below, remember, this is based on 19 employee numbers. But if they're below those numbers, then all wages count for the ERTC. Now, there's exceptions to it all, but if you're above 100 or 500, respectively, in 2020 or 2021, based on full-time equivalent employees, not full-time equivalent, I misspoke, full-time employees in 19, then you only get to include wages in which were paid to employees that were not providing services, assuming that all the other qualifications are made. So I was saying in jest and having a little fun, tongue in cheek, that number 80 might have been another reason that there was the aggregation rules to really be mindful of, is to also ensure that businesses in an aggregated group didn't get ERTC and PPP. So the aggregated group circumstances may help you, it may hurt you. I definitely, though, feel, and then I'm going to give you a link. Grant Thornton put together an article that just really analyzes. I don't like referencing articles ever, but this is a really good article that really is a research article. It's not an opinion article. It's pulling apart the law and then applying it and explaining the law, not by opinion, but by how the law reads. So anyways, I'm giving you a link to this. And really what it comes down to is the conclusion that I can give you is that, yeah, you take a partnership, a sole proprietorship, and an S Corp, sounds like we got an aggregated group potential there. So you would want to look carefully at that. Now, different from the rules of related individuals in determining who qualifies for the ERTC, as in the wages of that person, that is different, but you would need to look carefully when you're then talking about controlled group and you're talking about the affiliated groups, when you're then talking about a husband and a wife. And technically that can be different from state to state, believe it or not, whether or not it's common law or whatever the other law is for marriages. It's escaping me at the moment, but we know states have two ways that the laws work related to that. So believe it or not, some of that comes into play. So I do think a husband and wife pretty easily start to create a set of circumstances. But when you're looking at the aggregated groups, I think really what it comes down to is I think that there's going to be more businesses maybe than we're realizing that could fall into the aggregated group. And so to the question of someone who owns a bar and a law firm, is that an aggregated group? While I'm not going to give you a distinct yes answer on that because I don't know any of the facts and circumstances, but it sure sounds like there's a case that can be made that yes, that's an aggregated group. So if the bar is partially suspended its operations under governmental order, then it seems as though a case could be made that the law practice would be able to take advantage of the employee retention credit, even if it's in a different area, different jurisdiction, didn't have shutdown, wasn't shut down, did well, all the employees continued to work. Now, when you're aggregating it together, you'd have to first also look at, well, how many employees are there aggregated together? If we're doing it based on gross receipts, you'd have to aggregate all that together. But if it's based on the suspension, then might very well put someone in a circumstance where they would be able to get both. So at the end of the day, wow, this is deep stuff. And so if you have an opportunity or a consequence of an aggregated group, you definitely want to spend time, in my opinion, ensuring, because the thing I'll note to you last is that when you're reporting the employee retention tax credit, it wouldn't be collectively the bar and the law practice in that example. It wouldn't be collectively the partnership and the S corp and the sole proprietorship in the other example. It would be each entity, right? Each EIN, each payroll reporting, okay? That's where that credit would be reported. And so if there then is a question, so if you have an aggregated group and you have two groups that are claiming the credit, one of the groups there's an inquiry of, then you would want to have, you're going to need to have it already, but I'm just saying you would want to have your ducks in a row to feel very confident that in a circumstance where you have a law practice that didn't shut down and maybe in that area was considered essential and didn't change its operations, didn't change the revenue, whatever the case is, and that law firm took advantage of the employee retention tax credit, which very well may be able to do under the law. But if the law firm were to get inquired of, you would want to ensure in that circumstance that you had it sewed up, that you did qualify for the affiliated group or aggregated group. But I'll tell you, the hurdle's not as high as I originally thought. Okay, remember, we're 36 days into this in terms of the updated law allowing this to be retroactive. And so here's the other thing that I'm going to take solace in, okay? The IRS doesn't have any kind of revenue ruling or procedure or anything other than what we see on the website. Now, of course, we have the law, 2301, we have the 52 and the 414, of course, those subsections that we can go to. But, when we're looking here, this isn't necessarily a lot to go off of. When 2301 says, well, aggregation rules apply, then we look at these and we look at these, and we then have a million different interpretations. I do love it that the IRS gave us examples in 25 and 26 and 37 and 50. And even though 80 is obsolete, it does drive home about the aggregated groups. So again, it sure seems like it would be easier to be considered an aggregated group for ERTC purposes than normal. All right, hey, if you don't mind, I'm just going to show you one more time. So if you would like access, go to the link and you'd be able to get access immediately to the seminar that I did and get all the links. So the seminar that I did, 2.5 hours plus 3 hours of FAQs. You'll be able to get right here. It's got a link. You'll get the PowerPoint. I did a private research video talking about really making sure that we feel comfortable that clients or you are qualified, meaning like I think there's going to be more businesses that qualify than we realize, especially now knowing there's going to be more businesses that could qualify because of aggregation. The pink just means it's some stuff that I added here just in the last few hours, but look at all the information that you're able to get, flow charts and Excel spreadsheets and examples. And then, yes, a number of these are just links, but it's giving you links with all the information pulled together in one area. In the seminar, I do talk about the interaction of the SBA, PPP, and the forgiveness, as well as the ERTC. And then I've got these new sections just added since I did the seminar on aggregation, related individuals, and then how to report the ERTC for federal income tax purposes on that. So you don't have to go to the video. I've given you everything that I could right here. It's just that in the seminar, I go over another 2.5 hours worth of stuff not related to aggregation because I didn't hit it as hard as I'm doing right now during the seminar. So it's definitely an add-on. All right, hey, if you got to here and you're not a subscriber, boy, I'm gonna be sad if you don't now hit subscribe, because if you made it all the way to here, I'm feeling confident I've provided some value, some thoughts, some ways that maybe you're able to either protect yourself or take advantage of some things. And so I would love it if you would subscribe. All right, that was Amanda. All right, hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. All right, have a great one.